You've been stacking. You've been patient. You've been watching the numbers climb while everyone else called you crazy for buying something you could hold in your hand instead of clicking a button on an app. And now, with silver sitting above $70 an ounce, you might be feeling pretty good about yourself. But here's what I need you to understand right now. Right now. Because there is a specific, measurable, structural development happening in the silver market that most stackers are completely misreading. And if you misread it, if you make the mistake I'm about to describe, you could do everything right and still come out the other side with far less than you deserve. This is not a video about why silver is going higher. You already believe that. This is a video about the hidden trap that's sitting directly in the path of people who believe exactly what you believe. Pay attention. Let me start with a question that sounds simple, but absolutely isn't. When you say you own silver, do you actually own silver? I know that sounds insulting. You've got coins in a safe, maybe some bars in a drawer. Maybe you've been dollar cost averaging every single month for years, watching your stack grow from a handful of 1 ounce rounds to something serious. And you're nodding right now, thinking, yes, obviously I own silver. But a significant percentage of people who call themselves silver stackers own something entirely different. They own a claim on silver, a promise, a piece of paper that says silver exists somewhere. And theoretically, if everything goes perfectly and no one panics and no institution runs into trouble, you might be able to convert that promise into actual metal. Might, under ideal conditions. And the reason I'm raising this right now is because the conditions are becoming anything but ideal. And the gap between people who hold physical silver in their hands and people who hold a contract or an ETF or a pool account is about to become the most important distinction in this entire market. Let me show you exactly why. Quick note before I keep going. If you want a detailed guide on how to protect your retirement savings with precious metals, I put one together and it's free in the description below. Thousands of American retirees are already using the strategies in it. Worth a look whenever you get a moment. Now, let's talk about what's actually happening in the silver market at the structural level, because this is where the real story is. The global silver market is now in its 6th consecutive year of supply deficit. Let that number settle in your mind for a moment. 6 years in a row where the world is using more silver than it is pulling out of the ground. In 2026 alone, the projected shortfall is approximately 46 million troy ounces. That's not a prediction. That's not an analyst's forecast based on optimistic assumptions. That is a structural, mathematical reality that you can trace back to mines, to factories, to solar installations, to electric vehicles, to data centers. The demand is real. The supply constraint is real. The deficit is real. And yet, silver spot price recently pulled back from a peak that had been building throughout 2025, a year when the metal gained over 140%. People look at that pullback and they get nervous. They wonder if the story is over, if they missed it, if the fundamentals somehow stopped mattering. This is where the historical context becomes absolutely critical, because we have seen this exact setup before, more than once. And in every single case, the people who understood what was happening underneath the surface, not just the headline price, but the physical reality, those people were positioned correctly. The people who made their decisions based on paper price alone got hurt badly. Let me take you back to a story that almost nobody talks about in the silver community. And I'm not talking about the Hunt brothers yet. I'll get to them in a moment. I'm talking about the miners themselves, about something happening right now in the supply chain that most retail investors had absolutely no awareness of. The overwhelming majority of the world's silver, roughly 70 to 75% of all silver mined, comes out of the ground as a byproduct. It's not the primary target of the mine. Miners go underground looking for copper, for zinc, for lead, for gold, and silver comes along for the ride. What this means in practical terms is almost impossible to overstate. You cannot turn on more silver production the way you can flip a switch. If copper demand drops and miners cut production, silver supply drops with it. If a lead mine in Mexico shuts down, silver supply drops. The fate of silver supply is tied to the economic health of dozens of other industries it has almost nothing to do with. The miners aren't calling up silver buyers and saying, "We'll produce more if you pay more." They're mining what they're mining, and the silver that comes out is the silver that comes out. This is why the silver deficit keeps getting worse year after year, even though prices are significantly higher than they were a decade ago. Higher prices cannot simply summon new supply into existence when that supply is a byproduct of an entirely different industrial operation. The market cannot self-correct the way classical economic theory would predict. The deficit can persist for years, and as we've now seen, it has. Meanwhile, what's happening on the demand side is nothing short of extraordinary if you're actually looking at the numbers. Industrial demand for silver reached a record this year, over 680 million ounces consumed by industry alone. And the primary driver isn't jewelry, it isn't silverware, it's solar panels, electric vehicles, and increasingly the AI data center infrastructure that every major technology company on the planet is racing to build out. Here's something most people don't realize about solar panels. Each photovoltaic cell requires silver paste to conduct electricity. It's not optional. Silver is the most electrically conductive metal on Earth, and no manufacturer has found a way to replicate that performance at scale with a substitute material. Every solar panel that gets installed on a rooftop in Arizona, or a solar farm in Texas, or a massive energy installation somewhere in Europe contains silver. Permanently. It doesn't come back. That silver is consumed, and it doesn't re-enter the market. As solar installation programs continue to scale globally, that demand doesn't shrink. It grows every year on a trajectory that is hard to look at without feeling like you're watching a countdown clock. And silver's role in AI infrastructure is brand new and almost completely unappreciated by the average investor. Every server rack, every high-performance computing facility, every data center running the training processes for the next generation of artificial intelligence requires silver-bearing components for their electrical contacts, their connectors, their thermal management systems. The AI build-out that every financial media outlet is covering breathlessly is, at its foundation, a silver consumption event, and nobody is connecting those dots. Now I want to talk about the paper market, because this is where the wake-up call gets very specific for silver stackers. There are hundreds of millions of ounces of silver that exist on paper, in futures contracts, in ETF structures, in unallocated pool accounts at banks. And for most of the modern era, this has been fine. The paper and the physical moved together because there was enough liquidity and confidence in the system that it didn't matter much whether your silver was a claim or a coin. That dynamic is changing. And it's changing in a way that should make every serious silver stacker sit up and pay attention right now. Physical delivery requests from COMEX are up significantly. The premium between paper spot price and actual physical metal, the price you pay to walk into a dealer and take a coin home today, has been widening. Mints have experienced periodic backlogs and supply constraints that simply don't show up in the official spot price. What this is telling you, if you know how to read it, is that the paper market and the physical market are increasingly operating under different supply conditions. And when that gap gets wide enough, something has to give. It always does. The paper price has to move toward the physical reality, not the other way around. This is not speculation. This is how markets work when physical scarcity starts to assert itself. The futures contracts have to price in the reality of what's happening at the vault level, at the dealer level, at the refinery level. And right now, that reality is tighter than most people appreciate. Let me take you back to the story I promised you, the Hunt brothers, because it's not the story most people think it is. Nelson Bunker Hunt and his brother William Herbert Hunt were among the richest men in the world in the 1970s. Their father, H.L. Hunt, had built an oil fortune of almost incomprehensible scale, and when he died, the brothers inherited a mountain of wealth. But Nelson in particular had become consumed by something beyond money. He was watching what was happening to the dollar in the 1970s, the inflation, the oil shock, the end of Bretton Woods, where Nixon had severed the dollar's link to gold, and he became convinced that the monetary system as it existed was fundamentally broken. He believed that hard assets were the only real protection. So he started buying silver, first in modest amounts, then in aggressive amounts, then in quantities that would later be described as an attempt to corner the entire global market. By early 1980, the Hunt brothers and their partners reportedly held the equivalent of roughly a third of the entire world's annual silver mine production. They had taken silver from around $6 an ounce to nearly $50 an ounce in a matter of months. It was one of the most dramatic commodity price moves in recorded financial history. But then the COMEX, the commodities exchange where silver futures traded, did something extraordinary. They changed the rules mid-game. With Hunt Brothers money on the table, they enacted something called Silver Rule 7, which essentially restricted new purchases and forced leveraged buyers to liquidate. The price collapsed. Hunt Brothers faced margin calls they couldn't meet. The family that had been among the wealthiest in America filed for bankruptcy within a decade. Now, here's what I want you to take from that story, because most people tell it as a cautionary tale about greed or hubris, but that's not the lesson that matters for you right now. The lesson is this. Nelson Hunt's underlying thesis was correct. The dollar was being debased. Monetary policy had created inflation. Hard assets were being undervalued relative to paper money. His analysis of the fundamental problem was not wrong. His mistake was structural. He used leverage. He concentrated in a single instrument. He relied on a system of rules that could be changed by the people running it when it became inconvenient to let him win. The market makers changed the margin requirements on him when he was at the point of maximum vulnerability. Sound familiar? Sound like anything that could happen in a paper-silver market where large institutions hold concentrated short positions? Where margin requirements can be adjusted by exchange officials in real time? Where rules exist that have historically been rewritten when the wrong people started to win? The Hunt brothers weren't destroyed because they were wrong about silver. They were destroyed because they trusted a paper system to honor a physical reality. That is the core lesson. And it is perfectly applicable to the moment we are living in right now. Because here is what's different this time, and why the structural case for silver has never been stronger in the history of the metal's use as both a monetary and industrial commodity. The Hunt brothers were creating artificial demand. They were two extremely wealthy men using leverage to absorb supply from a market that wasn't structurally short. The deficit they created was manufactured through futures accumulation. When their buying stopped, when they were forced to stop, the market reversed. Today's deficit is not manufactured. It is not driven by one family's speculation or by algorithmic momentum buying. It is driven by the world's transition to renewable energy. It is driven by a global electric vehicle revolution that is still in its early innings. It is driven by artificial intelligence infrastructure that is expanding faster than most analysts can track. It is driven by 5+ consecutive years of mine production failing to keep pace with the things the modern economy requires silver for. You cannot force these industries to stop consuming silver by changing a margin requirement on a futures exchange. The solar panels still need the silver paste. The EV battery systems still need the silver contacts. The data centers still need the silver connectors. The deficit is structural in a way the Hunt brothers squeeze never was. And here is where I want to speak directly to the person watching this who has been stacking for a long time and is starting to wonder about the bigger picture, about what all of this means for your financial security, your retirement, the life you've been building. If you've been stacking silver as part of a broader strategy to protect your wealth against currency debasement, against inflation, against the kind of monetary disorder that we are genuinely experiencing right now, you're thinking correctly. But physical silver in a safe is only one piece of the puzzle. Here's something worth a moment of your time. If you're sitting on retirement savings and wondering how to get exposure to gold and silver inside a tax-advantaged account, a gold IRA might be worth looking into. You can hold physical precious metals, real, allocated, delivered to a vault metal, inside an IRA structure without triggering tax penalties. There's a free guide in the description that walks through how it works. Just worth knowing the option exists, especially given everything we're seeing in the macro environment right now. Back to where this is headed, let me tell you what the broader macro picture looks like right now for silver, because the industrial story is only half the equation. Gold is sitting above $4,300 per ounce. Think about that for a moment. When most of your neighbors bought their first house, gold was $300. When your parents started working, it was $35, because that's what the government said it was worth. The fact that gold is where it is today is not a gold story. It's a dollar story. It's a story about what decades of deficit spending, quantitative easing, and credit expansion do to the purchasing power of paper money over time. It's a story about what happens when central banks around the world collectively decide that dollars make a questionable reserve asset and start buying hard money instead. Central banks bought over 860 tons of gold last year. In the first quarter of this year alone, they purchased over 240 tons. Poland, Uzbekistan, Guatemala, Indonesia, Malaysia, countries that hadn't been in the gold market in decades are now quietly, systematically converting portions of their dollar reserves into metal. This is not a coincidence. This is not a trend. This is a coordinated structural reorientation of how sovereign wealth is being stored. And when you understand what gold's price is telling you about the dollar, you have to confront an uncomfortable question about silver. Because silver's relationship to gold, what the industry calls the gold to silver ratio, is sitting at roughly 60 to 1 right now. That means it takes about 60 ounces of silver to buy 1 ounce of gold. Historically, in metal-backed monetary systems, that ratio was closer to 15 to 1. For most of the 19th century, for most of recorded ancient history, in Roman times, in the age of bimetallism. The Earth's crust contains approximately 15 times more silver than gold, and for most of monetary history, that geological ratio was roughly reflected in the price ratio. Now, you can make a sophisticated argument about why the modern ratio should be higher. Silver is no longer official monetary metal. It has different liquidity characteristics. Gold is preferred by central banks as a reserve asset. These are valid points. But even if you're being very conservative, even if you think the ratio should be 40 to 1 instead of 15 to 1, the implied price of silver at current gold levels would be somewhere north of $100 per ounce. At a 30 to 1 ratio, which is still dramatically higher than historical monetary norms, you're looking at something well north of $140 per ounce based on today's gold price alone. And remember, we haven't even gotten to the industrial story. We haven't priced in the solar demand, the EV demand, the AI infrastructure demand, the sixth consecutive annual supply deficit, the paper market disconnect, the structural inability of mines to rapidly increase byproduct silver output. None of that is in the ratio argument. That's just a pure monetary valuation exercise based on where gold is trading right now. The inflation-adjusted story is even more striking. When silver spiked to its nominal high back in 1980, adjusted for what the dollar has done to its own purchasing power since then, that equivalent price today would be somewhere in the range of $200 per ounce. And that's using official CPI calculations, which most serious economists consider to significantly understate real-world inflation. Use the M2 money supply as your deflator, accounting for how many more dollars exist today than existed in 1980, and the equivalent purchasing power of that 1980 peak becomes something almost incomprehensible by today's prices. The point isn't to give you a specific price target, because nobody, and I mean nobody, can tell you exactly where silver will trade at any given point in time. Markets are not math problems. But what the data is telling you very clearly is that silver, relative to gold, relative to its own history, and relative to the dollar's own trajectory, is priced at levels that don't fully reflect the structural supply-demand reality it's operating in. Now, let me bring this full circle back to where I started, because I want to make sure the wake-up call lands with the specificity it deserves. If you are a silver stacker, here are the things you need to be absolutely clear on right now. First, what you hold matters more than how much you hold. A stack of physical silver in your possession is fundamentally different from a silver ETF or a futures position or an unallocated pool account. Not because there's anything necessarily fraudulent about those instruments, but because in a world where physical delivery is being requested more aggressively, where the paper-to-physical premium is widening, where the structural dynamics of the market are shifting, the person who holds the actual ounces holds the actual ounces. Everyone else holds a promise, and promises are only as good as the conditions under which they're being honored. The Hunt brothers held physical silver. They also held a mountain of leveraged paper contracts. When the paper system turned on them, the physical silver still had real value. The paper contracts destroyed them. You are not the Hunt brothers. You're not leveraged, you're not trying to corner the market, and you're not dependent on exchange officials to play fair. But the lesson about paper versus physical is timeless, and it has never been more relevant. Second, the supply story for silver has no easy fix. Unlike other commodities, where a price spike eventually summons new production, silver cannot be switched on in response to market signals because it isn't primarily mined for itself. The byproduct reality means the deficit can persist far longer than most traditional supply-demand models would predict. 6 consecutive years of deficit is not a blip. It is a structural condition with a momentum that doesn't reverse quickly. Third, the macro environment that is driving gold to levels most people couldn't have imagined a decade ago is the same macro environment that makes silver's monetary case compelling. De-dollarization isn't a fringe theory anymore. It's happening in real time. being executed by dozens of central banks who are quietly diversifying away from US Treasuries and into hard assets. The geopolitical tensions reshaping global trade aren't going anywhere. The level of sovereign debt globally, and particularly in the United States, isn't a problem that resolves itself without significant consequences for the purchasing power of paper currencies. These are not short-term trading themes. These are decade-long structural shifts that take years to fully price into hard asset markets. And fourth, your silver stack, as valuable and as strategically sound as it is, needs to be part of a broader wealth protection strategy. Physical silver in a safe is excellent, but it doesn't live inside your retirement account. It doesn't grow tax-deferred. It doesn't have the legal protections that come with formal retirement structures. And for people who have spent decades building retirement savings, people who have followed all the conventional advice, maxed their 401k contributions, accumulated real wealth, the question of how to protect that wealth against the things we've been discussing is one that deserves a serious, educated answer. Because here's what worries me about the conventional retirement model in the current environment. If you've done everything right, if you've saved diligently, and you have a substantial retirement account, the overwhelming majority of that wealth is probably sitting in dollar-denominated assets, stocks, bonds, mutual funds, things that go up and down with the market, things that are priced in the very currency that central banks around the world are quietly moving away from, things that get hurt by the same inflation that precious metals historically protect against. That's the fundamental tension, and it's not going away. You've been stacking silver because you understand something important about the world, about what money is and what it isn't, about the difference between an asset with real intrinsic value and a promise printed on paper, about the gap between official narratives and underlying realities. That instinct is correct. The data backs it up, the history backs it up, and the current structural conditions in the silver market make the case for physical hard assets as compelling as I've seen it in a very long time. But the wake-up call, the reason I called this video your final wake-up call, isn't just about whether you should keep stacking. It's about whether you're stacking the right way, whether you're protecting wealth in all the places it lives, not just in the places that feel obvious, whether you understand the paper-physical distinction well enough to act on it when the moment demands clarity, whether your retirement savings have any protection against the same forces that are driving silver prices to the levels we're seeing today. If you're still watching this, that tells me you take this seriously. You're not here for the entertainment. You're here because you're trying to make intelligent decisions in a world that is sending real signals through real markets, and you want to understand what those signals mean before everyone else figures it out. So here's what I want to leave you with. The sixth consecutive silver deficit is not an accident. The growing premium between paper and physical silver is not noise. The record industrial demand, driven by solar, EVs, and AI infrastructure, is not a trend that reverses on its own. The central bank gold buying, over 860 tons last year, accelerating into this year, is not a coincidence. The gold-to-silver ratio, stretched to levels that historically have preceded major revaluations in silver's favor, is not a random data point. Every single one of these signals is pointing in the same direction. And the people who are positioned correctly when the paper-to-physical disconnect fully resolves, when the sixth year of deficit finally forces the market to reprice silver against its own physical scarcity, those people will have made one of the best risk-adjusted calls of this generation. Don't let it be the thing you understood perfectly and still got wrong because of how you held it. There's a free guide in the description that goes deeper on the wealth protection strategies I've touched on in this video, specifically for people who want to understand how physical gold and silver can work inside a retirement structure to protect against exactly the kind of monetary and geopolitical risks we've been discussing. If you've been watching all the way through and you have over $100,000 sitting in any retirement account, I'd specifically like to offer you something additional. Mention this video when you reach out through the description link, and you'll get access to an exclusive one-on-one educational web conference at no obligation. No sales pressure, no fine print. Just a real conversation with someone who can walk you through the mechanics of protecting hard-earned retirement wealth in a way that matches your actual situation. That offer is for American retirees only, and it won't be available indefinitely. Pay attention to what the market is telling you, and make sure that when this move fully develops, everything you've built is positioned to benefit from it. Not just the coins in your safe, but every dollar you've worked a lifetime to earn.